Welcome to The Explainer. Today, we're going to jump right into a really interesting debate, one that pits Wall Street tradition against a more long-term vision. The big question is, should companies have to report their earnings every 3 months? Or would everyone, investors, managers, the whole market, be better off if they only did it twice a year?
This is a conversation that's been kind of bubbling under the surface for years in financial circles. But recently, it just exploded into the mainstream. It went from the business section to the front page, all because of one post on social media.
And just like that, what was a pretty niche Wall Street debate was suddenly front-page news. It immediately framed the entire discussion as this big, clear battle. Do we want short-term pressure, or do we want long-term strategy?
So, this raises a really big question, right? Is making this switch actually a good idea? The answer has massive implications for how companies are run, how you as an investor get information, and really for the fundamental workings of our markets. So, which way should we go?
Okay, so before we really get into the weeds of the arguments, let's make sure we're all on the same page about what we're actually talking about. In the United States, public companies file these quarterly reports, which are called 10-Qs, 3 times a year. Then they have one big annual report, the 10-K. The whole debate is really about those 3 quarterly check-ins.
And here's the crazy part. This system we're all debating, it's not new. It's been the law of the land since 1970. We're talking over half a century. That really shows you just how deep-rooted this practice is in American finance.
All right, so let's start with the case for shaking things up. The folks who are pushing for less frequent reporting, we can call them the semiannualists, they argue that this one change could unlock some huge benefits for companies and for the entire economy.
So their whole argument really boils down to 3 key points. First, it just plain saves money. Second, and this is a big one, it helps companies focus better, shifting their gaze from the next 90 days to the next few years. And third, they believe it could make going public more attractive again, especially for smaller, growing companies.
And don't just brush off that cost argument. We're not talking about pocket change here. Consultants estimate that a decent-sized company can spend around $40,000 just on the reporting process every single quarter. Now multiply that across thousands of public companies, and you're looking at a massive amount of money.
But honestly, the cost is just part of it. The real centerpiece of their argument is this idea of short-termism. The thinking goes like this. If you're a CEO and you're constantly stressed about hitting your earnings target for the next quarter to keep Wall Street happy, are you really going to make that tough, expensive call to fund a big research project that might not pay off for 5 years? Probably not.
Okay, so we've heard one side. Now let's flip the coin and look at the defense of the way things are right now. The people who support the current system say, hang on, these problems are being blown way out of proportion, and the benefits of regular, transparent info are just too important to give up.
And what's interesting is that their main counterargument takes that whole short-termism claim head-on. They basically ask a very simple, direct question. If the American system is so obsessed with the short term, shouldn't we see that reflected in how much companies are actually investing for the future? Well, when you look at the data, the story it tells is probably not what you'd expect. A Goldman Sachs analysis found that U.S. companies, the ones reporting quarterly, actually invested 37% of their cash flow back into things like R&D and long-term projects. That is more than double the 17% from European companies, where reporting twice a year is much more common. Okay, so what about that other argument, the one that says all this paperwork is why fewer companies are going public? Well, defenders of the current system say not so fast. They point to the absolute explosion of private equity, which has created this huge pool of capital that lets companies stay private for way longer, completely separate from any reporting rules.
So, what are we left with? We've got 2 really strong competing stories. One says the system is fundamentally broken, the other says the data proves it's working just fine. Lucky for us, there's a perfect real-world experiment we can look at to help settle this. See, if you hop across the pond to Europe, things are different. There's no single rule. For about the last decade, the market there has been pretty evenly split. About half the companies report quarterly, and the other half report twice a year. This sets up a fantastic natural experiment to see what kind of difference it all makes. So Goldman Sachs did the logical thing. They decided to compare these 2 groups head-to-head. They looked at key performance metrics like profitability, which is what return on equity measures, and also how the market values these companies, using the PE ratio. And, well, what they found is pretty wild.
I mean, look at this. The results are almost identical. It's kind of shocking, right? Whether a company reported 4 times a year or 2 times a year, their profitability and how the market valued them were pretty much the same.
So that big game-changing payoff that was promised from reporting less often, it's just not there in the data.
Okay, so if the hard data from Europe suggests this change is kind of a wash, then what's the point of this whole debate? What are we really arguing about here if it's not about the numbers on the balance sheet?
When you strip it all away, this whole conversation comes down to a classic push and pull. On one hand, you have the absolute right of an investor to get timely, transparent information so they can make smart decisions. And on the other hand, you have a company's need for some breathing room, some space to build and innovate for the long haul without getting constantly yanked around by the market's reaction every 90 days.
And that brings us to this final thought from the Barron's article, which is kind of funny, but also makes you think, right? If tweaking the frequency doesn't really move the needle, maybe the whole debate is pointing to something bigger. It makes you wonder, what information actually creates value? And in a world that moves this fast, is it possible the very way we measure a company's success needs a complete overhaul?